What's up, everybody? It's Chris Rowe, founder of True Market Insiders, and I'm here today to talk to you about one of the most potent indicators and one of the most well-known technical indicators that'll help you with your market timing. It'll help you buy low and sell high. Or if you're bearish, it'll help you sell short really high and buy back at a much lower price. It's called the MACD, the Moving Average Convergence Divergence Indicator. You might have heard about the MACD, and you might know some of its rules. But I actually learned about it from the person who created it, Gerald Appel. Now, it's not like I had some sort of intense workshops or anything like that. I called him on the phone a few times. I discussed the indicator with him because I wanted to write about it and to create a video about it back in 2007. He actually worked up the block from me. So what's a MACD? Well, let's talk about the construction of the MACD. It's called the Moving Average Convergence Divergence. It's right there in the name. So you just take two moving averages, and when they converge or when they diverge, when they come close together or when they move further apart. It's very simple. So a moving average is one of the first things that you'll learn when you learn about charting. A moving average, all it does is it smooths out the price data that you'll see on a chart. So a chart might be moving upwards, but it's zigzagging up and down. And if you got scared anytime it moved a little lower or got bullish anytime it moved a little bit higher, you'd be buying and selling all over the place, and it'd be very emotional, very terrible, and it'd probably lose you a lot of money. So you don't want to do that. So a lot of people use moving averages, and they use moving averages in various ways. One is just to smooth out the data, to try to eliminate the noise. And what they do basically is you'll see a price chart of the stock market or an individual stock or some sector or something, and you'll see that it zigzags around, and you'll see there's a very smooth line over it giving you the general idea of the general direction. You can see it on your screen right now. There are faster moving averages and there are slower moving averages. When you're averaging out a longer period of time, like 50 days, it's going to move slower than a moving average that averages out 10 days. Okay, because the one that averages out 10 days is a smaller sample study, and it's going to be more sensitive to the price movement of a stock. So what you could do is you could take two moving averages, and you have a faster one and a slower one. And a lot of people like to use two moving averages as an indication on when to buy and sell. You use the two moving averages, faster and slower, and when the faster one moves above the slower one, it's positive momentum. And when the faster one moves below the slower one, it's negative momentum. And when the faster one moves above the slower one and it starts moving further and further away from the slower one, that means momentum is increasing. And again, if that's happening in the upwards direction, it means that positive momentum is increasing. And when you have a stock or an index where you have positive momentum increasing, it's really, really strong, it's very hard to knock that stock or index down. It actually takes a couple of chops away at that stock or index before it does turn around, and I'll dive into that in just a second. As you can see on your screen right here, this is IWM. It's an exchange-traded fund, and it tracks the Russell 2000. It's basically small cap stocks, smaller companies. Okay, so IWM, and we're going to look at the Moving Average Convergence Divergence, aka the MACD. Now, you might notice that there's a middle point on the MACD section of this chart. So the middle point is called the zero line. And when the MACD is above that zero line, there's positive momentum. And what did we say before? Positive momentum just means that the faster, more sensitive moving average is above the slower, less sensitive moving average, right? So that's anytime the MACD is above zero, you know that the faster moving average is above the slower one. And as it gets closer and closer to the slower one, because that positive momentum is still positive, but it's slowing down, that's going to reflect in the MACD as getting closer and closer to the zero line, moving closer and closer. Because when the MACD is exactly at that zero line, the two moving averages are exactly at the same point. There's zero difference, and that's why it's at the zero line. So if the faster moving average moves below the slower moving average, the MACD is going to move below the zero line. So very quickly, you can look at the MACD, and you'll know immediately that there's negative momentum. And if that MACD is not only below the zero line, but it's moving lower and lower below the zero line, you know that that downside momentum is getting stronger and stronger. And behind the scenes, what's really happening is the faster moving average, the more sensitive one, is below the slower moving average, and it's moving away. So it's diverging. Moving average convergence divergence. When it's diverging, momentum is getting stronger. When it's converging, momentum is getting weaker. Now that zero line is going to come into play in a minute. I'm going to start talking about buy signals and sell signals and confirmations of those buy signals and sell signals. Before I dive into that, let's just talk about the settings of the MACD. When you open up a chart, a lot of the times by default, they'll already have the MACD there. Don't think that just because it's popular and everybody knows about it, that it's not a great indicator. A lot of people will make the mistake of adding all kinds of different indicators and obscure indicators that nobody really ever heard of. Adding lots of indicators doesn't make you a better and better trader. In fact, some of these well-known indicators are some of the most potent indicators, and that's why they're the default settings. So if you open up a chart and you see the MACD is there, they're probably going to have a setting of 12 and 26. 12 and 26 is the standard, it's the default, and what that means is the MACD is focusing on those two moving averages. Overlaying IWM's price chart, we're going to put two moving averages. We're going to put the 12-day moving average and the 26-day moving average. And below that, we have the MACD, which uses those same two moving averages. And you'll notice that when those moving averages converge, they get closer to each other, the MACD moves closer and closer to that zero line. And when those two moving averages diverge, move away from each other, the MACD is either, well, it's moving further and further away from the zero line, either in an upwards direction or a downwards direction. So IWM is on your screen right now, and the MACD settings are 12-day moving average and 26-day moving average, and MACD is a single line, and that single line shows you the difference between those two moving averages. Very simple. When the difference gets bigger, momentum is increasing. Now, the signal line is going to be added to this in just a second, but I want you to just look at the MACD line. This is what the MACD used to be. There wasn't a signal line initially. I had a conversation with the creator of the MACD, Gerald Appel, and he told me that even though it was a great indicator, when it was just one line, it did give false signals, and it would upset people because it would have a reversal up, which typically would be called a MACD buy signal, just the fact that it went from downwards to upwards. But you would get a quick blip upwards and then a continuation downwards, and that just wouldn't do. That wasn't enough. That gave lots of false signals. So the original MACD signal was when the MACD line moved from going down and reversed back up, and as long as it happened below that midpoint, below that zero line. Okay, so that was an official MACD buy signal. And the official MACD sell signal used to be if the MACD line was above zero, okay, so everybody knows that positive momentum is on the chart right now, and then it would reverse down. But again, you'd have false signals because it would reverse down a little bit and then keep going back up, and there was a lot of false signals. So what Gerald Appel decided to do was to create a moving average for the MACD. We refer to this as the signal line. Now, by default, you're going to have your signal line at 9 days if it's a daily chart, or 9 weeks if it's a weekly chart, whatever 9 periods is depending on the chart that you're looking at. So you look at that MACD signal, and now instead of just the signal being a reversal of the MACD line, it's a reversal of the MACD line and it has to cross over that signal line. So now the official MACD buy signal is when the MACD is below zero, so momentum is negative, and the MACD line reverses up and crosses above the signal line. That is an official MACD signal. It's confirmed because it moved from below to above the signal line when the MACD was below zero. Now, I told you about that zero line before, and I told you that we would circle back to it. And we just covered a MACD buy signal. It's when it was below zero, reverses up, and crosses above that signal line. Well, the next confirmation that some more conservative traders want to see is that MACD continuing higher and moving above that zero line. So again, you're a little bit more aggressive if you go for that MACD buy signal by just that line reversing up. You're a little less aggressive if it reverses up and you let it cross over that signal line. That's what most people consider a MACD buy signal. But even more conservative is waiting for more proof that momentum wants to go positive. Remember, if the MACD gives you that buy signal, if it's below zero, it's still considered negative momentum. It's just dramatically improving. And then once it crosses above that zero line, that's considered positive momentum. So some traders, if they're more conservative, want to see it cross above the zero line because the MACD buy signal isn't good enough. They want to see that confirmation. Usually those are going to be longer term investors. They have a bigger focus and they're not really focused on that little narrow 5.5%, 10% gain. They're looking for 100%, 200% gain. Setting the stage, the MACD sell signal is when you have the MACD moving in an upwards direction and then it reverses lower and crosses over that signal line. Now again, a lot of people will take that as the sell signal, but more conservative people want to see a cross back below that zero line to confirm the sell signal. Now I told you I learned a lot about this from the man himself, Gerald Appel. So there's some tricks that some people don't really even think about, and I'm going to tell you one of them right now. When the MACD makes a very steep move, so say the MACD goes from below zero to above zero, but it does in a very steep way. Instead of gradually, it seems to go from down to up very, very quickly. That is a sign of more strength to come. So when you see outrageous momentum, when you see momentum change dramatically from one extreme to another, that's when you know there's more of that to come, or it's very likely that it's more of that to come. So if you see the MACD buy signal, but the MACD jolts way above that zero line very, very quickly, it's runaway momentum. It's like a runaway train. Imagine trying to stop a runaway train. It doesn't just stop dead in its tracks. It takes a lot of force to stop it, and it takes some time to chip away at it. Well, same thing with the MACD. You have positive momentum that's very strong, and it increased in a dramatic way. It's going to be very difficult, usually, to get that stock to reverse lower. So you might get a sell signal in the MACD, and it's worthless. If the MACD has a sharp, very steep move higher, the sell signal is going to be very questionable. And I'm going to talk about that for a second now. Here's a caveat. Here's something you absolutely need to know, and a lot of people don't know this. The MACD puts in a buy signal and then trades from below zero to above zero. And you're in an upwards trend. So the major trend is upwards, okay? Your buy signal is going to be potent because the buy signal is the entry point. I'll say that again. It's more potent because it's the entry point. Technical analysis always assumes that you're investing in the direction of the big trend, okay? Because that's the smart way to go. Then you have the wind at your sails, so to speak. You're swimming with the current. You're not going against the grain, and 5 other analogies I could probably add. You get the point. So when you're in an upwards trend, technical analysis assumes that if you buy, you're entering your position, like most people do anyway. That's the more potent signal. Then within that uptrend, the stock might become overbought and then reverse lower, but it might just be temporary. And you'll get a MACD sell signal. And you have to understand that the sell signal, when you have an upwards trend, is your exit signal, right? Because you're trading in the direction of the trend. You're not taking bearish bets. You're not betting on a downwards movement. You're betting on an upwards movement because you're smart and you trade with the trend. You understand technical analysis. You understand probability. So when you have a stock that's gunning higher and then you get the sell signal, don't take it with a grain of salt. Don't ignore it, but understand it's a lot less potent. You're going to want to see more proof, especially if the MACD had a steep move higher. You're going to want to see more proof. It's suspicious. So you'll get that sell signal, you get the signal line crossover, and take it not with a grain of salt, but don't take it as seriously as the entry signal. Also, I'm going to want to see more proof that this stock wants to reverse lower. Even though if it's in that uptrend, it wants to reverse lower temporarily, it wants to correct, it wants to go back to the reaction levels, it wants to regress back to the mean. So I'm going to want to see a negative divergence. And a negative divergence is when the MACD is not confirming what the stock is doing. So the stock goes higher, blasts off, pulls back a little bit, causing that first MACD sell signal. You say, I don't buy it just yet. And then the stock continues even higher, but the MACD does not go higher. Stock goes higher and then reverses down. The MACD is going to go higher and reverse down too. However, that second high in the MACD is going to be a lower high, even though the stock made a higher high. So when that MACD makes a lower high, not confirming that stock's higher high, that is called a negative divergence. And it's very important to know that because a negative divergence is usually a precursor to a price decline. And it works in the opposite direction too. I did this direction first because it's the one that's traditional and everybody's used to trading with stocks going up and getting out as soon as they're at their peak, right? Well, people also trade in the downwards direction. People bet against stock prices. They profit from stock prices trading lower. I'm sure you've heard of selling short. Basically, you're selling the stock without even owning it, and then you buy it back cheaper. Or maybe you buy a put option, which has an inverse relationship with the price. So the stock goes down, the put option goes up. The bottom line is you see on the chart the stock's declining, and you are betting that it's going to go even lower. It's really fun, really exciting, and keep in mind, stocks and indexes trade lower 3 times faster than they trade higher. Very important rule to understand. Now, in a market where you have declining prices like you see on your screen here, when is the entry point? Little quiz, pop quiz. Where is your entry? Is it a buy signal or a sell signal? Do you enter when you see a buy signal or do you enter when you see a sell signal? Now, technical analysis always believes that you're doing the right thing. You're swimming with the current, right? The wind is at your sails. So your entry point in a downtrend is going to be the sell signal. Your exit's going to be the buy signal. So we assume that we're not buying puts or calls. Let's just pretend that we're trading stock, right? So the stock is trading lower. You're going to sell short to bet against that stock. You're going to make money when it goes down. So you are selling, and that is your entry point. The buy signal is the exit point. What do we say about the exit point? It's less reliable than the entry point. So your entry point's the sell signal. Sell signals are more reliable in the downtrend, and the buy signal is less reliable. However, if that MACD puts in a positive divergence, that's usually a precursor to a bullish reversal in prices. So if you see that MACD put in a low and then a higher low, while the stock puts in a low and then a lower low, that buy signal that follows from the MACD is definitely potent, and it is to be respected. Now, finally, I'm going to wrap this up, and if you like what you see here, please subscribe to this if you want more. I want to help you. Honestly, technical analysis isn't that difficult, and most people make mistakes by reading the news and looking to the financial media to see what's going to happen. And then they take that information and they try to guess what's going to happen next, and then hopefully they're right about what's going to happen next. And then they're also guessing on how the rest of the world is going to react with their buying and selling, and it doesn't make any sense. Besides, it'll always show up in the price behavior before it shows up in the news. My news headlines are price behavior. I look at price behavior because that's what's really happening. Analysts lie, CEOs lie, the media lies, and a lot of them don't know what the heck they're talking about, including people in the financial services industry. But if you look at what's happening with price behavior, that is what's telling. The people that know what's happening ahead of time have so much money that they're actually moving markets. So focus on price behavior. It's not that difficult. Here is your bonus. And again, subscribe to this YouTube channel. It's at Chris Rowe Trader. I'm on all social media, at Chris Rowe Trader. Like it, share it, comment, and I'll answer your questions, but most importantly, subscribe if you want more. All right, so the bonus round with MACD. You might be in a market that is experiencing very strong momentum. So for example, if you're in a bull market and it's very strong momentum to the upside, prices are gunning higher, and that MACD almost never goes below zero, right? Now, when the MACD goes above and below zero, what does that mean? It means the two moving averages are crossing above and below each other, right? And when the faster one crosses above, it's turned into positive momentum. When the faster one crosses below, it's negative momentum, right? Well, you can always change the settings on the MACD, or not always, but if your chart service allows you to, you can change the settings on the MACD. You can change it so that it's more sensitive and then you get the signals faster. You can change two things. You can change the signal line. By default, the signal line takes 9 days of activity in the MACD and averages it out, smooths out the data, reduces the noise. But you can change that signal line from a 9 to a 3 or a 6 so that you get earlier signals to exit or to enter your position. So if you're in a big, strong bull market, you don't want to miss that buy signal. And you don't want to wait until the MACD gets below the zero sometimes. If you wait for it to go below the zero line sometimes, you might be waiting forever. So what you can do is you can actually change your settings to make your MACD a little bit more sensitive. You can do that by changing the signal line to a lower number, but also the two numbers that create the MACD, right? The two moving averages that create the MACD, you can change those numbers, especially that first number, that lower number. So instead of having a 12-day moving average with a 26-day moving average, you can look at a 9-day or an 8-day moving average with that 26-day moving average, and you'll get bigger swings, and you'll get bigger moves in the MACD because you're going to get bigger convergences and divergences. I am all nerded out for one day. How nerdy did we just get? Subscribe to my stuff. I want to show you more. Always remember that it shows up in the price before it shows up in the news. And I'm Chris Rowe at True Market Insiders. I'll see you on the next one.